All right, welcome back to the Kelowna Real Estate Podcast. I'm your mortgage broker host, Taylor Atkinson.
And I'm your real estate agent host, Glenn. What's happened, Taylor?
Well, we just had a great show with Caroline from Lakepoint Capital.
Yeah.
You know, as she left the studio, which was cool. We haven't done an in-person one in a few months here with the summer.
Yeah.
We were talking about like our question of what advice would you give your 20-year-old self? I was kind of thinking like, what advice would you give, you know, your son who like Julian, who's 20-year-old today? Like, because I think giving yourself 20-year-old advice is like kind of skewed. So yeah, what would you tell Julian today? I think you and I were kind of talking a little bit off air of like the real estate market and is this time different and it's cyclical. And, you know, with Caroline, we were really talking about, you know, things will self-regulate. And so, yeah, I guess you're talking to Julian over coffee, beer. What advice would you give him?
So like, I guess the bottom line question is this time different? It feels like there's so much negativity and like, how are we ever going to get out of this? And like, honestly, I don't know the answer to that. But is this time different than every other like slowdown or recession? I don't know if we're in a recession yet or going to be, but like, is this time different? And like, I'm not entirely sure it is different. I actually know it's not different. It'll come back. Just, I don't know when. I don't know if it's next month or next year or wherever. But like, it feels like a few things have to happen for it to come back. It will come back. So for Julian, for what would I invest in real estate? I would still invest in real estate for sure. Definitely an emphasis on cash flow. So buying a property that creates income, and whether like that's the right property, whether there's commercial, probably you're leaning a little more towards commercial, to be honest, and having more of a down payment, make sure that you're cash flowing. If you're in a situation where you're out of pocket $700,000, $2,000 a month to pay for an investment, I don't think that's a good situation to be in right now. But if you can cash flow, preferably quite a bit more than break even, I think real estate would still be a good investment.
Yeah.
And it will come back. It just, obviously we don't know when. We've talked a lot about what has to happen for it to come back. And it feels like costs have to come down, which they're not coming down. Like land prices, DCCs, but like generally they're not coming down.
Yeah.
So I think our economy has to catch up. The wages and inflation, the rest of it has to catch up to what it's at. And then when that happens, I think we're just going to be in a good position again.
Yeah, I agree. Is it different right now? No, it's probably more magnified than it ever has been, just with like social media and news and,
yes,
you know, people being able to educate themselves with their fingertips on their phone with probably like bad education. You know, really it comes down to like whatever the headlines are going to pull in readers.
You think the same thing though happened in the boom?
Yeah, but I think that worked in the opposite effect of people.
Yeah,
the market's hot. Like you can't miss on making money. Yeah. Like just buy anything. And then people got that like FOMO type of mentality.
Yeah.
And now like the pendulum swings pretty massively the other way.
Yeah.
So yeah, I don't think it's entirely different. I do think it's different in like how difficult the solution now is because it's been compounding year after year after year now. And I do think with the influx of, you know, population growth by mostly immigration that we've had during like really bad years, to have that just like, again, magnified that problem. But I think that will help the solution in 5, 6, 7 years, like having that population growth in 5 or 6.
Our population, they like stopped immigration.
They have now. Yeah. Totally.
Which is almost also bad time.
Yeah. It should have happened the other way. Like we should have stopped it 3 years ago and started it now.
Well, we should just have a regular, just even for our social issues, we should just have
totally
a regular amount of immigration every year.
Yeah. But I think the population we have, although it was difficult to like absorb all that, will kind of pay dividends in the future years if we can kind of get through this tough time. My advice to my 20-year-old son today for real estate, I would say, yeah, for sure, buy your own owner-occupied primary residence place. But I would do it with like house hacking in the sense of like, you know, buy something with a basement suite or buy something where you can add a basement suite, you know, put a tenant in there, get some cash flow out of it. Or the other option maybe would be if you wanted to roll the dice a little bit, I do think some of the like old Airbnb allowable condo units will potentially come back.
Yeah.
And if you're buying that as an owner occupied, and if they change that legislation, well, I mean, you can even do that now anyways, although getting a new business license is tough. But if you can get in there and that bylaw changes in the next few years, once there's some confidence back, you'll see appreciation, but you can also see, hey, go travel for 6 months and then rent your place out and you have that ability to make some money. Those would be kind of the two avenues I'd take. I mean, if it was a single family home with a basement suite, I think that's the best because I think that asset class, no one's building those right now that's affordable. So if you can buy something that's a bit run down, get some sweat equity, put a tenant in the basement, awesome. A little bit outside real estate, more in like education, I would say, yeah, go travel, spend a lot of time traveling, invest in AI or anything like in a new business that you can kind of manage.
Invest time or money in AI?
Whatever is accessible. If time is accessible, you can do a lot of research on it. Like we've talked about this before, you just ask AI, what should I do to learn about AI?
This is my problem with AI and investing in it is like, spend all this time and I can just be like, how do I do this AI?
Yeah.
AI is progressing so fast that it's almost not worth it to learn it because it's just going to know how to use itself.
Yeah.
You know
Yeah.
what I mean? So that one's moving so fast that it's hard to say what to do. Definitely have to be involved in AI.
Yeah. I think as the younger generation, for sure, that's like, yeah, something you have to be educated in. So learn how to like implement that stuff, go travel, get some life experience. But yeah, for real estate, honestly, I don't know if I'd recommend them just to go and buy a rental place, unless, like you said, there's value add or it cash flows.
Yeah.
I would not be buying a rental based on it's just naturally going to appreciate right now.
Yeah. So both of your real estate suggestions were basically added value, whether it's a law change from the Airbnb or forced equity, like building, like renovating.
Yeah.
Suite.
Yeah.
Yeah. I think that's solid advice that works in pretty much every market.
Yeah.
Right.
And I mean, I think everyone's a little skeptical, nervous right now, but again, like that's probably the indicator that now is the time to like find some opportunities.
It's not going to be this forever. So probably is a good time. There are good deals out there for sure. Like not every place you buy is going to be a good deal, but they do exist. So I feel like there is opportunities to go ahead. It feels like a situation where 4 or 5 years from now, we're going to be like, damn, I wish I bought 2025, 2026.
Yeah.
I just think it's pretty against the grain from people we talk to and just somebody is in business, but it just feels like it's just ripe for that kind of attitude in a few years.
Well, hey, and to go back to Caroline, our guest today, is like, they're busy. Like they're working with a lot of developers right now. So like if wealthy, smart individuals that have been doing this for decades
teams of people to make decisions
are like going to secure financing with Lakepoint Capital are still doing that and still making money. Like there's opportunities that, you know, common people can't kind of wrap their head around. So
kind of build off this, like one other thing for Julian, you don't know what you don't know. Like when you walk down a building, or walk downtown, all those buildings were like at some point in history, like someone's dream or like someone's passion project for 4 or 5 years, or maybe longer than that, maybe less, but like every single place is like that. And you don't know what you don't know. You don't know how to put together a deal or how to build a building or how to structure it to buy it or like all the different things there is to do with this. So I would take some chances for sure.
That's a superpower. That superpower erodes over time as you get older and you kind of learn those lessons the hard way. Yeah. But man, like I made absolutely terrible decisions. Not all, but a lot of them worked out really well. And it's just like rolling the dice on you don't know what you don't know. And like, hey, this seems like a good idea. I've, done some research. I've done my due diligence.
Like you don't know what you don't know, but mind just like in the back of your head is that like somebody's doing it.
Yeah.
Why can't it be me?
Totally.
Like everyone here is probably a 20-year-old that didn't know anything at one point. And so like, why don't you just do that?
Yeah. You got to take some chances. And, in your early 20s, I think that's the time to do it for sure.
Absolutely. Definitely. And yeah, there will be opportunities to take chances on. So definitely.
Yeah. We'll cut to the show. It's a good one. Caroline, Lakepoint Capital. If you have any commercial financing needs, reach out to them. They're awesome.
They are. This episode, like every episode, sponsored by Century 21 Assurance Realty. We're everywhere. Wherever you go, we're the best brokerage there's going to be. Commercial real estate, residential real estate, leasing, property management. If you're an agent looking for a place to go, or if you're a buyer or seller looking for an agent, Century 21 is a brokerage for you. Enjoy the show.
Okay, welcome to the show, Caroline Coudreau from Lakepoint Capital. So we've had one of your other
Musketeers, yeah.
Yeah, Brian Stevenson on. That was probably like a year ago.
Maybe longer than a year ago.
Yeah. So lots of pressure on you. I mean, that guy can talk. So yeah. No, we love Brian.
That's why he's out there talking for us.
Yeah, exactly. I love working with you guys. Like as a residential broker, we kind of like feed clients back and forth, whoever is kind of best suited. Yeah. So we wanted to bring you on today because Matt and myself have had a lot of clients recently and in the past just ask about development projects on a smaller scale, infill projects, how that looks from like a lending point of view. I think a lot of people just get land or have, a house with some land on it, and they think like instantly they can just kind of fund a project and make money on it, but there's a lot of complexities. So yeah, we wanted to have you on to kind of discuss that. But before we dive into it, we just want to start, what's kind of your perfect Friday look like in terms of, what do you do for work, and then leading into the weekend for some fun?
Okay, so ideal Friday, and I'll let you guys decide which part of this statement is true and which is a sort of a projection of what it could be. So I wake up Friday, I go into my kitchen, everything's clean, immaculate somehow, and grab my kids. They're ready to go to school, no fussing there. I drop them off, give me a big kiss, and off they go, jaunting along, happy to learn. Right?
Yeah, you're in a dream world. Okay.
I get back to my computer, start that up. Wow, a lender just sent me a commitment letter for one of our clients. It's perfect. It's exactly the way the offer looked originally. No changes in terms there. And so off we go to the races. I call my client, say you're approved. Oh, and bonus, the rates have come down and that's just automatically cut in. And so, we're saving you extra money on top of our usual ROI. Then another email comes in from another client, and all the information is there. Everything that we'd requested is nicely packaged, nicely labeled, and ready to start on a new deal, right? So
yeah, I like your Fridays.
Yeah, me too. And then at 12 o'clock, like clockwork on Fridays, I go to Muay Thai. And so I do kickboxing, Muay Thai at Pacific Top Team. And that's just it's really fun.
Have you been doing that for a while?
It's been about a year and a half.
Nice, good for you.
Yeah, and I've stuck with it actually. And so really starting to see some progress there. But it's just a great way to de-stress, decompress, I live in my head and I constantly have deals running in my head. And so, but when somebody's trying to, beat you up, then you can't really think about that. So it's really pushes everything else away and you become ultra focused in the zone. And so that's my
I love it.
way to
I'd love to get into Muay Thai. I've thought about it, but I just never pulled the trigger. Maybe this is the
neat. Yeah.
Hey man, we got to focus on the hockey team first. We got to get some W's up there before we join some more time.
Sure, related.
It could help. A lot of fighting in hockey, right? So
hopefully not as much kicking. But.
No.
Yeah.
With your skates. Good luck. Yeah. That's ultimate balance. Yeah.
Okay, well, maybe we can kind of run through that perfect client that has everything. So obviously, we probably both struggle with collecting all the information up front and, what we need. But let's say, hypothetically, somebody has either purchased or have an existing piece of land and, it can be, say, 4 or 5 acres, like a big chunk of land, and they want to build like stratified units for resale. That could be a single family house or townhome, duplex, whatever. They come knocking on your door, have the land, have it in a corporation maybe. What are kind of the next steps of that phase? Like we're auditing their financials and, the ability to cash flow and the ability to, resale. Can you kind of walk us through that process?
Yeah, definitely. So, I'll caveat this with most of the time when developers come to us to support their financing, they've got, sort of their ducks in a row typically, right? But just walking backwards as to sort of the process. If you have a site and you're looking at what can I do with the site, then you should probably do a bit of your own research in terms of local official community plans. What's the rezoning here? What's the possibility? You may want to engage an architect such as Lime Architecture. They're really great. They can do sort of a site assessment plan and give you sort of the best use of that plan for relatively affordable, preliminary costs before you get involved with hiring all the consultants and everything like that. So it's a good idea to think about what can the site support, right? And once you have an idea of what your site supports, then you can go to start to build out your project budget, right? And so the project budget is going to look at your hard costs. So that's just, the framing, the everything right? And then the soft costs, which involves your consultants and all the fees that you're going to have to pay, development costs and building permits and all that stuff. And then you also want to factor in an interest reserve. So depending on how much you plan on borrowing and the timeline that's going to take to build out that project, you're going to have some interest costs incurred and then setup fees, financing costs, legal fees, all that stuff, right? So that's part of your project budget. And then lastly, you want to build in a contingency reserve, which is kind of thinking about, okay, where can things go wrong and making sure that I build in a buffer for costs going up, right? And so once you have your project budget, the total cost of what it's going to be to develop this strata You may want to think about also phasing that project and what that looks like, right? So, we can go into those details later, but let's just look at your total project cost. So now you know what it's going to cost you to build it. Well, we need to look at the other side of that, which is what's it going to bring in? What's it going to generate in revenues, right? So for that, you can again go back and, try and limit your costs, look at just market comparables. You can talk to a realtor to run some comparables for you, or you can hire an appraisal company as well to kind of give you the appraised value as complete. So whatever your project is going to be, they're going to give you an appraised value on that. So the challenge with that is that appraisers are often, in one of their approaches, looking backwards to see what has been recent sales comparables to sort of derive a value, right? And that's what the lender is ultimately going to rely on as well, right? So you have your appraised value and then you have your project cost. Well, one minus the other is your profitability, right? So, and that's going to be critical for you to make sure that you want to embark on this journey, right? And then it's also going to be important for the lender to make sure that there's enough of a minimum threshold there to call the project viable, right? So,
what is their general loan to value or profit margin that they're looking for?
So profit margin, the lowest threshold I've seen is 10%. And so that's your profit divided by your total cost of your budget, right? And really what that signals to the lender is that there is a bit of a buffer there. So if the market does take a turn or, there's a reduction in the end value, because you have to think when you start planning this project, you may not have a deliverable and for another, minimum 12 months to 18 months to 2 years, or to some of these bigger projects is 3 years, 4 years, right? So what the market can support right now, is that going to be the case and by the time it's completed? Right.
How do you gather all the costs at the start? You talk to a developer?
Yeah, you would talk to builders. So depending on the scope of your project, there'll be builders that kind of, fit that mandate. They have experience. You want to make sure that they have experience building that type of product, right? Yeah. And then you want to get a few quotes. And so in the earlier stages, as you're developing the, preliminary drawings, they can give you sort of a Class C budget, which will be kind of, not refined, but at least give you a good estimate of what your costs are going to look like. And that gets refined as...
And would they help with the soft costs as well? Or?
They should be able to, determine to help you with the soft cost.
So when a lender's looking at it, do they want to see the quote that you're getting, or is an owner just presenting what they think it's going to cost at the end?
Yeah, so for smaller projects, you may, get a few quotes from a few different builders. Yeah. And then, based on that, you can put together your own pro forma, right? And builder's not likely going to give you all the soft costs or, because there's the development management, which is running through the rezoning, getting the permits and, managing everything from a holistic perspective. And there's a builder actually going to the site or managing all the trades and things like that, right? And so you have those kind of different responsibilities in a project depending on the scope, right? If it's just a small project that you're undertaking yourself, then you kind of become the development manager, right? And you just hire out for the build, right? And so, to answer your question, if it's a larger project and lenders looking at it, they definitely want to see your contract with the builder. Okay. And there's different types of contracts. So you can have a fixed price contract. Yeah. That's preferable because that mitigates the risk of, the materials and the labor coming in higher because the builder has kind of committed to a cost for that project. However, it's more expensive because the builder has to also build in contingency, right? And so a lot of developers typically go for a cost plus, right? And in that case, lenders are going to look at making sure that there's sufficient contingency there, as well as the developer having sufficient liquidity to inject into the project should costs come out different than what originally planned, which is what happened after COVID, right? And we saw this huge jump in costs. But, if you're midstream and you haven't really built in a buffer, then that can be a real challenge because you run out of money. And then your product doesn't.
Imagine right now it's a double whammy where people over COVID get huge cost increases and then right when they go to sell right now,
exactly,
price drops.
Yeah, with that, in today's climate, are you seeing lenders be a little more cautious going into this or reducing the loan amounts they previously were looking at?
There has been ups and downs in that fluctuates all the time in terms of lender appetite, but the costs have sort of stabilized. But as you said, the value may have, eroded somewhat, right? Depending on the product, right? Mm-hmm. So as just basic economics, right? As supply comes in and based on all the economic factors, demand has shrunk, right? So then, there's pressure on prices. But the issue is that those projects actually, in some cases, I was looking at listings and I'm saying, you can't even build for that today, right? So that's actually a steal. Mm-hmm. So it may be a good time if you're sitting on the fence, to pull the trigger and buy, because you may not be able to find that.
It's funny, Taylor and I talked about this, like the cost to build is not coming down, right? Like it might stop going up. It's definitely not coming down.
Yeah, that's the tough part right now, especially for appraisers. Like appraisals come in, lower, especially on like refis, but the cost to build that is like far outweighs whatever that appraisal came in at. It's tough to communicate that to the client of like, we're talking about recent sales and comparables, and like there are no sales that support what you want in the value of the home. Although to build it would be like 20 times more than, or not 20, but like 20% more than what the appraisal has come in at. But I guess that's where like on these construction financing, like you guys really have to dig in and be thorough, because like lenders can't stick their neck out and then a year goes by and the project doesn't sell. Like they have to protect themselves against markets kind of turning that way, right? So
yeah, that's exactly the issue right now, right? Is that a lot of projects aren't penciling. So something has to give. But you think about the budget, costs have to come down. So hard costs may not be coming down, but the cities are now talking about DCCs, like lowering DCCs, or at least helping the developers not to have to pay those costs up front, and trying to get them to pay at the end of the project. So that helps with their cash flow, right? Because another part of construction financing is you have to have your equity in, right? And your equity goes in first and is last to come out, right? So all these developers have their equity tied into the projects all the way up until the loan is paid out, and then they can finally start to recover those funds, right? So yeah.
So to simplify that part of it, let's say someone wants to build 10 units and they're going to do it 2 units at a time, and they're just single family homes. Like when they sell the first 2 and they're midway through construction on, units 3 and 4, and then they're pouring foundation on units, 5 and 6, et cetera. When they sell, they don't see any of the net proceeds. Like that goes to paying the lender back their portion of that mortgage balance. Mm-hmm. And then does the lender then like redeploy more capital to start building? So it's kind of like a not revolving, but like a bit of an open line of credit at a portion on that.
Yeah. So that's where you really have to look at the terms and the conditions of the financing arrangement at the beginning, right? And so that's why developers have, taken some of these larger projects and build out in phases, right? So that their equity is not tied in. They don't need the full project equity right away, because they just need the equity for that phase, basically, right? And then they can sell those units and then take that profit, hopefully, and move it into the next project, right?
So do you guys set that up on a phased project, or do you have to like resubmit the application on each phase and say, okay, we've completed phase 1, here's what we're looking for phase 2? Or is it set it and forget it? Like you guys kind of set it up at the beginning, and then after that, they just work directly with the lender?
The financing is set at that point at the initial, because you'll have typically like a land draw or a residual land loan balance, right? Because you're not utilizing all the land. So you have some equity tied into what's called a residual lot or land. You can actually move lenders on the next phase. They would just have to make sure that it all makes sense in terms of them being able to take out the residual land, and everything would be cleared at that point, like discharged. So that definitely has some more complexities to it to understand that picture. I think that's why developers, they do the phases, because taking into account what their equity is and how many units they can pre-sale as well. Like you're not going to release, 500 units all at once, and you're not going to build 500 units all at once, right? So it's better to do it in these sort of phases.
Yeah, I had that with a client a little while ago. Do you guys see that on smaller scales as well for pre-sales? Again, we'll just use 10 as a number. Mm-hmm. Do you get better financing options if you have pre-sales? Like you can show a lender, yeah, we've already sold, 2 of the first 10. Does that help with it, or do they force people to do pre-sales, or what does that look like?
Yeah, pre-sales are a way for lenders to de-risk the credit facility. So basically, depending on the scope of the project. So for smaller projects of 4-plex, you might get away with not requiring a pre-sale, right? But for anything larger than that, that's going to be one of the conditions to being able to access the funds. So you can go to a lender and actually get approved subject to meeting these conditions, and then you can go and market and try to achieve those pre-sales, right? But That's why some of these projects are getting shelved right now, is because they, had the construction facility in place approved, but they weren't able to meet that condition of pre-sale. So that's definitely something you really need to think about.
How many do you need to pre-sale?
So it's going to vary from lender to lender. And you're also going to have to look at the residual loan value and your liquidity as well, right? So generally 1 for every 4 units is a good rule of thumb, but that really depends on the project metrics.
So
right?
if you're building like Taylor's 10,
Mhm.
do you have to sell 2 or 3 of those before any shovels in the ground right away?
Before you can access a part of the construction loan.
Okay.
Yeah. So you might get an advance based on the land value.
Okay.
Yeah. And that will allow you to pay out the previous lender or to acquire the property, right? Yeah. But then any subsequent draws will be conditional upon achieving those pre-sales.
Yeah, interesting.
Yeah.
So,
is there anything, and I mean, we've talked about this a couple times on the show, but so MLI Select, super hot over the past 3 years.
No pre-sales, right?
Yeah. It's like a great tool, or was a great tool. I think it has its limitations now with some of the premiums coming up and stuff. But is there anything on this side, like what we're talking about financing today? Like, are there grants, government programs, lender programs? Like, where is the incentive for developers to take on this type of risk and build single family homes? I don't know. Are there not programs, and should there not be programs to help with that? Because to go knock off 20% pre-sales,
more than that.
It could be unrealistic. And if it doesn't happen, then what, we're just stuck in this market where homes are not affordable. Like, that's the whole point of
this is a major discussion happening right now, and the developers have come out to try to explain to the population who don't understand what they're working with, right? Aside from that, they're talking about, when the data comes in as to construction starts, that project was actually penciling like 3-4 years ago. Data that's coming out on construction start looks optimistic, looks like, things are great. But the reality is, what's happening right now is not conducive to more construction happening in the next few years to meet that demand that they're projecting, right? So in most municipalities, like in the Okanagan, they're projecting a minimum of 1% growth per year, right? So on a population of 150,000, that's 15,000 units per year that you need just to support that growth, right? But if you look at the development starts right now, or the construction starts right now, or the permits that are being issued right now, that's nowhere near.
Yeah.
So what's that going to mean for the future? It means that we're not going to have the supply that we need to meet that demand. What's going to happen to price at that point, right? And so that's why there's a push to help people understand that, hey, the developer is not a bad guy. Investors are not bad. They actually help to get these projects going because they're the ones who are providing the equity and, de-risking the project for the lenders, right? So they're actually
people buying the pre-sales.
Yeah.
Yes.
Yeah.
I mean, I guess it's kind of self-regulating there.
Yeah.
The value is going to go up so much. It's going to be hard for people to purchase. Well, that's exactly when developers are going to start to build more, when they have a better profit. But like, why would the government not foresee that now and be like, hey,
because it's reactionary and, and because it has to come from an understanding of the people have to demand those changes, right? So first you need to understand what the issues are, which I think, a lot of people don't, because it's not part of their daily life. And they just see that values have gone up like crazy. And they think that, the investor and the developer are to blame, right? Mm-hmm. So until that paradigm shifts, then we're going to continue to see these, ups and downs versus a more controlled growth, right? And the issue is back in 2018 to 2020, labor was so tight. You have to train all of these skilled workers to build, right? And so, it takes time for that. And now you have, I was talking to the Okanagan Community College and they were saying, yeah, a lot of the skilled workers are retiring and, the new workforce coming in, it takes time for them to get that experience, right? So it's not something that you can just turn off and turn on again, right?
It's kind of funny when you have like during 2021 and 2022, like Taylor and I every single week on the show would talk about a new regulation coming in and new this and new that. But things are just cooking up. The government's just pulling all these levers, everyone they can. And then when this happens, it's like, oh no, what happened? Mm-hmm. I was like, well, kind of got to ride it up and ride it down. It just seems like it's not very far-sighted to build changes.
Well, their mandates are 4 years at a time or something, right? So, yeah.
Well, and something like pre-sales kind of got a bad name when people were buying them and then assigning them
Mhm.
and making a lot of money. So then the capital gains tax on pre-sales came in. But now we kind of need them back. So before we were beating with the stick, and now it's like, come on, please come back. We need you. We need you to fund all these projects.
But if you look at, okay, for an investor to tie up their equity, and if prices are not going to go up the way that they have been, you know, what's the incentive there from a return perspective, right?
Yeah.
So it's going to be challenging to bring back the investors to the market.
Yeah.
And so really developers have to think about the end user and appeal to the end user.
Yeah.
But the issue is that when you make the decision to buy something, it's usually like, I need something now, right? Or in 6 months. It's not in 3 years, all,
Totally.
right?
Yeah.
Well, it's like, so when we were talking about pre-sales before on like the 10 unit or the 4 unit, I'm thinking as a practical realtor, if I see 3 fourplexes for sale, like my clients are going to buy the one where they can walk through it, and like, because you see all those, like there's different levels of quality that you just don't see from a rendering, and like there's a lot of factors there, and they're obviously just going to offer the one that's built. So I think it'd be pretty hard, especially now when there's a bit of a glut in the market, to sell pre-sale when there's existing ones. So
Yeah. What does it look like if somebody wants to buy raw land and build? Like, is that most of the equity, right? People are sinking their equity in the land and then the financing comes after that? Or are you guys financing the land as well up front?
Yeah. So typically if you're acquiring a piece of land, then you can get land financing or land and servicing and subdivision. There's a process before you get to construction, and that can be financed based on the value of that, right? So yeah, a lot of equity will be tied into the land, but depending on what you're building on that, will it be sufficient to carry you throughout the whole project? Probably not, right? Our example with the client that we shared that you referred to us, he had bought the land about an acre back in 2021, and he had done all the site servicing, and subdivided it into 5 bare land plots. He finished all that just at the time that the market was shifting, but he had tied up all his equity in that land, right? Because it required quite a bit of servicing. And so he was kind of land rich, but did not have the equity he wasn't sure how to move forward. He tried to sell the lots, but nobody was buying at that time. It was a bad time to sell the lots, right? And so he thought, what can I do with this property? At that time, the municipalities were also pushing for higher density. And he thought, okay, well, I can take this project and build 10 units, right? So 5 duplexes. So the project would be 10 units total. But that city at that time had not automatically zoned single lots for duplexes. So he actually had to cancel the subdivision and start over with a development permit for
Lake Country.
a phased close. Yeah. Yeah. And I think they ended up fixing that later on, but for his timing didn't work out. So he was very hesitant to go and cancel, the subdivision and take that leap of faith before having the construction financing in place. And so that's when Taylor introduced him to us. And I got him comfortable enough with our ability after working through the numbers and looking at the pro forma and appraised values and everything that we could get the construction financing. So he went ahead and did that and canceled the titles, and we were able to get him in phases. So with that example, we were able to secure a land loan and a construction loan for the first phase, which would be just 1 duplex, so 2 units. And then once that was paid out, then he could activate the next construction facility. But that might change. So if he's really successful and he can sell those right away, then he might accelerate that project a bit, right? But at least we were able to get him a solution that worked.
But that's the crazy thing about that example is like the government's implementing things like every week. I mean, it seems like it's been a bit sleepy over the summer, which has been nice, but like density, boom, that totally changes somebody's plan. And like they just spent all this soft costs for developing or even hard costs for like setting up utilities and stuff. And now it's just such a waste of money because it's just like, how do you keep up with a developer trying to keep up with the government and like, hey, we have a 3-year plan. And then by the end of that 3 years, it's like, well, this isn't profitable anymore because like the land use is wasted.
Yeah. And just because they say that this land is now good for 10 stories, that developer may not have the experience to develop 10 stories. The landowner thinks, oh, the value of my land just, quadrupled, right? Actuality, they go to sell it and they can't sell it, right? So these are sort of numbers that, you really have to work through the actual.
I actually read an article a couple of weeks ago, and this is a bit off topic, but I think it's pretty interesting. Is in the article they wrote that like the densification, like on the legislation that they've come out with recently provincially, is not actually helping with affordability, because now it's instantly made like the land more valuable, and that's currently the most like expensive thing. Not the most expensive
Driving
thing,
the budget.
Driving prices up. So now, okay, great, you can build 4 units on this piece of land. Well, technically now that land is worth more, so it's driving the price of the land up. So it's not creating affordability in those 4 units.
That will self-correct, in time, right? Because the developers, they're running the numbers, right? And so if it doesn't make sense, it doesn't make sense. They're not going to buy that land. And then you're going to have accumulation of land on the market and not selling, right? And so what do you tell your client at that point? It's just, hey, if you want to sell, something has to give. Right? You gotta,
Wait longer.
just wait longer. Yeah.
Yeah.
6 years.
Maybe we should do $1,000 decrease on the price.
Yeah, so.
Right. Finding that's, an easier conversation now to have.
Well, no, not really.
No.
Well, because it makes sense, but nobody wants to see their neighbor's house go for X and then yours is X minus 10%. Or 20% or 30%. Right? It's just not a psychological game that people will play.
It's funny. It's very easy to accept it when it goes up by 10%. It's like instantly, oh, absolutely.
Yeah.
And it's in stone.
Goes down by 10%.
10%.
No.
That's it.
Yeah.
Never going down. It makes sense when you think about it, but the reality is not always like that.
So I moved here 2 years ago.
Yeah.
And I'm really sad I didn't move, 6 years ago.
Yeah.
I could have sold at the peak in Vancouver and bought before everybody else here, right? But yeah, it's funny how in 5 years, I think it doubled, like the value in Kelowna real estate doubled in 5 years, right?
Yeah.
Those are enormous, jumps, right? And but nobody remembers 5 years ago.
Yes.
So crystal ball,
Yeah.
do you think the trajectory is going to go up? And I mean, we talked about this with supply and demand, but how much more can it go up?
So I definitely think about this a lot. And, all the municipalities had to put out these housing needs reports, right? And I urge people to look at that and really think about where those numbers are coming from, right? And so what drives housing needs? Population growth, right? So it really depends because they are projecting 1%, but what just happened recently? Well, population growth has actually slightly declined.
In BC?
In BC.
It's wild.
Which is crazy, right? So are people even going to want to migrate here? That's a big question, right? Because if unemployment is creeping up and they can't find jobs, are they going to want to come and live here, right? And if they don't, then are we going to need that new housing projected? So it's all related. So it's hard to say.
Well, I guess too, as inflation goes up, talked about building costs are not going, wages are not going to come down, materials are not going to come down, land prices probably will come down, DCCs maybe will come down.
Well, I mean, they've been saying whatever $300,000 is zero. So so you can keep your DCCs the way they are and not get any, or you can make some concessions and
totally.
Yeah.
And then you also have active taxes like property taxes and people buying services and there's revenue to the city in other ways than just DCCs.
Yeah, but a lot of what we see has been supported by DCCs, right? Happening. So.
Yeah. But I guess, so everything being equal, so as inflation grows and the costs stay the same and the land values come down, housing will get affordable again. It's going to go up again, but our dollars are going farther. Or no, sorry.
The opposite, right? Yeah. Our dollar's worth less.
Yeah.
Yeah. I heard some crazy stat, and don't quote me on this, but it stuck with me. Something about if you look at the value of housing in Canada versus gold, you peg it to gold, it actually hasn't really increased for a long time, apparently. So that would be interesting to dive into.
Yeah. When you look at it over a long period of time within exponential growth and inflation, it does get muddies the waters a little bit, but definitely population driven for sure.
I mean, Kelowna's great. I think more people are going to want to come and live here, just like myself, leaving the city and, wanting all the amenities of the city without, I mean, as much as the locals complain about the traffic here, it's relatively easy going for someone coming from a bigger city. Yeah. So it's a great place. So I'm very optimistic about growth here. Yeah.
I guess people are going to move somewhere else because it's getting better jobs or it's more affordable. Like we just have to be better compared to where they're going. And so like, where are they going to go from here is Alberta. Like, I don't think they're going to be as much down south, like going to the US and stuff. So it's to be competitive in Canada. And are we worse off than other places in Canada? Like, probably Alberta right now. We're not as good as jobs and also more expensive. But I think as it levels out, that will also level up.
I think geographically, Canada's been a very difficult place to manage as a country, right? Like small population, so small revenue on taxes, massive piece of land. How do you build infrastructure to support that? I think the catalyst to like really throw our housing just completely, in the shitter, sorry, but like it's just like the last couple of years have been tough. It's like we had a massive population growth, like the most we've ever seen immigration at a time that like we did not need it. And like, we need immigration, but like it was just such poor timing of that. So I don't know. Like I think it will self-regulate a bit. Actually, I really do think it will self-regulate. I think what we need is less government intervention and just let things balance out.
Exactly. What we were saying before was like less everything at once. If you're going to tweak a lever, just tweak it and let it go for a couple of years or a few years. And then
don't yank on it.
Like everything at the same time.
Yeah, it's crazy. Like the building code changes, the environmental, all the cities needed step codes. So
that's great. Environmental is great. Accessibility is great. But like at what cost? For people not to be able to ever afford their home, well, then it's not practical.
No, but that's also self-regulating, right? People are leaving. If you can't find a job and you can't afford a place to live, you're going to leave. So that is self-regulating. It just takes time to work its way through the market.
Yeah, we're not that patient. Come on.
Fix it.
I want my cake now. Yeah. Well, to kind of segue into like our wrap-up questions, and we might spend a little bit of time on this one. 2-part question. If you were to buy one property in the next 12 months in Kelowna, what would it be? But also, maybe you can answer this one first, is like, where are the opportunities for smaller time developers and the value add that like Lakepoint Capital brings of like reviewing someone's land and project and saying, hey, you know what, like this is a really good, I know you're not advising on like the best use of land, but hey, here's something creative we can do financially, or here's like a really cool lender that has a product that's like pushing this direction. Where are you seeing developers build right now and make money?
Yeah, so I think for that middle housing, I think it's going to be an opportunity for sure. Even though some of that product has been sitting, I think that there is pent-up demand. Just need to, get a little bit more optimistic about the next couple of years before people pull that trigger. But
like townhome type stuff?
Yeah. But townhouses that are sizable enough that, a family can live in comfortably, because some of the product that was developed in the last few years, very small. And if you think about a family of 3, and Canadians, we're kind of accustomed to a bit more space. And so, you're just not going to have necessary demand for a 1,100 square foot. Even I've seen like 800, 900 square foot, in my opinion. I could be wrong.
I think you're right.
Yeah.
As a realtor, I think you're right about that.
Yeah. So I worked with a lady and she's got a project coming up soon, which I think is great because it's townhouses. And they're about 2,000 square foot each townhouse with 4 bedrooms. And the layout is very functional for a family, as well as maybe even having a room for an office that's attached to the garage, right? So people working from home have a bit of separation. So I think that layout's very functional. And the price point was about $800,000. I think that's a good product, right? You have to think about, okay, what does a young family earn and what kind of space? If you can make that work, then I think you have a good product, in my opinion.
Yeah. And then like putting on your investor hat or dreamer hat, not that you're a dreamer, your kids go to school without crying, we get it. But so do mine.
Today, like their dad dropped them off. So.
Yeah. What excites you in the next 12 months? Where would you buy? What would you look for?
So a side of me is, I like nature. I have a huge respect for farmers. And so having an acreage up in Southeast Kelowna would be great, right? And having a vegetable farm, maybe an orchard or something. That's
cool.
Yeah.
Yeah, I love Southeast Kelowna.
Yeah, I'm close. I'm in Hall Road. So
Yeah, you're on the edge.
Yeah. I don't have the acreage though. So that would be my next step.
Yeah.
That's awesome.
Yeah, I just suck at gardening, so I'm not with you on the farming side. But yeah,
I know. That's why I say my dream, like my alter ego, not my real self.
yeah, okay.
If you could give your 20-year-old self any advice, what are you saying?
So going back, I would say buy real estate. Yeah. I don't know if I would say that now, but
Well,
I would say 20-year-old self. I don't think we're going to see these enormous, jumps. At some point, the equation has to break, right? And wages are not keeping up with the rising costs in housing. And at some point, you can't afford it. Like you can't afford it, right? There's no market for it. So, and then there's a lot of rental product that has come online, which is
like a lot,
which is nice, right? So it just depends. It depends on what you're looking for. But as an investment, unless there's real value add that you can, convert this land into 10 stories and really take that project through, or just a rental property, I'm not sure I would, that would be my investment at this time because of the numbers right now. So I can relate to the lack of investors at the moment. Yeah.
Yeah, totally. What's your favorite charity, or how do you give back?
Oh, raising my kids at the moment. That takes a lot of time and energy. So I haven't been as active with volunteering my time. But one organization that I think is amazing is Mamas to Mamas.
Yeah.
Mamas for Mamas. Yeah. So I really love them because, they're just really close to the community. It's a grassroots movement, and it's really about being a mom and giving back. And so I'm a monthly donor there, and I donate, the kids' stuff and things like that. But I'd love to get more active than that. And
Yeah, they're awesome.
All right. How can Taylor or I or our listeners help you? What can we do for you?
Well, come and visit our website at lakepointcapital.ca. So we work with business owners, developers, and commercial property investors.
Yeah.
And so there you can see a list of, our success stories and why we exist in the market and how we're helping our clients to, save money, get more flexibility on their terms, and greater leverage. That's a priority for them. So love for you to go and visit.
Yeah.
Get some traffic onto our website.
You guys have been awesome to work with. So I appreciate the partnership, and I'll stay away from the Muay Thai. Though
Hockey. Yeah.
Yeah. Matt and I are going down the hockey route. Well, thank you so much for coming on. Yeah, I really appreciated your insight, and we'll keep sending clients your way.
Yeah, it's been great.
Yeah,
Thanks
thank
for
you.
having me.